This is All India Radio. Under the Azadi ka Amrit Mahotsav series of Spotlight program, now we bring you a discussion on economic reforms gathering momentum. The participants are Dr Arvind Panagariya, former Vice Chairman, Niti Aayog, and Siddharth, economic analyst.
Welcome to this conversation with Dr. Arvind Panagariya. He is Professor of Economics and the Jagdish Bhagwati Professor of Indian Political Economy at the Columbia University. More recently, he was the Vice Chairman of Niti Aayog. And before Niti Aayog, Dr. Panagariya was the Chief Economist at the Asian Development Bank. Welcome, Dr. Panagariya.
Thank you, Siddharth.
Sir, you have been associated with several of the reforms since 2014 in your earlier role as the Vice Chairman of Niti Aayog, and some of the building blocks were put in place, such as the JAM, which is the Jan Dhan, Aadhaar and Mobile Network, the Insolvency and Bankruptcy Code, GST, the subsidy reform, and also the privatization process. How do you view these reforms?
So, this is a good list you have given, Siddharth. Let's start with the JAM Trinity. Actually, Aadhaar came first, and that was very important because everybody had to be given an identity. And moreover, this was a biometric identity, therefore it couldn't be forced. Then created these bank accounts, which are known as the Jan Dhan accounts. The objective here was to give a bank account to at least every single household. Mobile, of course, was an ongoing thing. Mobile spread had started and considerably kind of kicked off by the reforms that Prime Minister Atal Bihari Vajpayee had done. And during the UPA rule, they expanded at a breakneck speed. So by the time Modi administration came, we had lots of mobiles. So Aadhaar multiplied very rapidly. Likewise, Jan Dhan accounts, there was 1 week during which so many millions of accounts are created that the Guinness Book of Records actually carries that fact. Then there were two very big reforms that were done, the Insolvency and Bankruptcy Code and the GST reform.
Sir, one of the aspects that you worked on was, closure of sick public sector companies and the privatization process. In fact, it was the recommendation by Niti Aayog which led to the privatization of Air India. How do you see the pace of the entire process exercise so far?
So there's an interesting piece of, I could say, history here. That what had happened was that how we started this process. So apparently there were two enterprises for which a proposal was floated to rehabilitate them, what we call the renew them or restructure them. And this of course involved a substantial expenditure. So the file had come to Niti Aayog for commenting as well. We recommended one to be closed down and one to be, I think, allowed to be restructured. And then I think, once this was done, the following week, the Additional Secretary himself came and said, why don't we ask the PMO to consider more generally the closure of sick units as well as privatization of some of these enterprises. I said, yeah, of course, I'm very happy. I'll support it. Right. I didn't expect that we'll get a green signal from the PMO. Lo and behold, actually, I think within a month we got the green signal. And then, of course, we began going at it. So, that is how this process was launched. And then we, of course, set up very systematic set of committees once we got the permission. Brought in some experts to do detailed study of each of these enterprises. We started classifying. There were enterprises that could be restructured. There were enterprises that were too sick to be restructured, so they ought to be closed down. By November of 2016, our first list of recommendations that had been actually approved by the cabinet. By 2017, before I left Niti Aayog, Air India had appeared on the radar screen. And we were asked actually to write the first report on the privatization of Air India, which we did at a fairly quick pace. And in the end, I'm very pleased to say that, roughly pretty much the terms on which we had suggested that Air India ought to be privatized, it was privatized.
Do you think the building blocks are in place for India to take off from the current state of affairs to a bigger economy, one which is more inclusive and which is there for the next 50, 100 years?
Let me first review actually what we have achieved. I think listeners should understand where we are coming from and then we look at where we should go. So I'll give you not the full long history, but just, let's say starting with 2014-15 under Prime Minister Modi. I think first 5 years, the economy grew about 7.4% on average. So it's a decent growth rate. In the sixth year, which is the 2019-20, we did have a decline, to 4%. So that was the result of the inheritance in the financial sector. A lot of reckless lending had happened over the years. So it was inheritance for the government. And as a result, the non-performing assets in the banks really multiplied and financial sector really became messy. And that was at the heart of this slowdown because credit growth had taken a big beating, and then also the non-bank finance companies came to fill the gap. But then we also ended up with a crisis there with Ireland FS going near collapse. The government had to then come and ensure that it was rescued. So that was the background. But overall, during the first 6 pre-COVID years, the economy grew about 6.8%. That's the average growth rate, with the caveat that actually first 5 years was another percentage point, 7.4%. Now, COVID hit us, and obviously in the COVID year, which is the 2020-21, growth rate did fall. It was a negative growth rate. The GDP actually fell by 6.6%. But then we have bounced back in 21-22, about I think 8.6 or 8.7%. They're bouncing back a solid. Probably, the growth rate is higher than in any other country, and our growth rate is also predicted in the coming year by all the institutions, including the IMF, the World Bank, etc., to be close to about 8% at least. That's where we are. Now, I think looking to the longer run, I think a lot of our reforms we have put in place, and we mentioned these two, but I would also add very big ticket reforms. IBC, the Insolvency Bankruptcy Code, GST. The third, I would say, rationalization of the corporate profit tax. By ending many of the exemptions, almost all of the exemptions, we have brought down the corporate profit tax on manufacturing firm investors to effective rate of about 17%, and on all the other enterprises about to 25%. So we are globally competitive on that dimension. Then labor laws have been really a very serious impediment, and significant labor law reform has happened. Fifth, I would mention this has to do with replacing the Medical Council of India Act by the NMC Act, which is the National Medical Commission Act. So there was huge problems with the prior act. It was an old archaic act from 1956. Prime Minister blessed it. They gave it to Niti Aayog to write a new law, which we did. And we consulted widely, of course, and now you can see how rapidly the medical colleges have been expanding. And the figures I've checked is between 2010 and 2020. If you look at the seats for medical colleges have been doubled. So these are very important reforms. There are a few others. I think if we do a few more other things, I have absolutely no doubt that we should grow at least at 8%, and with a few more, I think we can get to 10.
So what would be those set of the missing links, if we could call them, in terms of the future reform areas?
First and foremost, somehow this idea of import substitutions has still kind of remained alive, particularly in our bureaucracy, but also I think among the political class. And so this has gotten traction, and we have gotten into import substitution strategies big time. When you impose tariffs, custom duties, and you make these import competing products more profitable to produce, then capital flows into these goods. Well, it's going to flow into these goods from somewhere else, and that somewhere else is going to be the exportable goods. So supply of exportable goods will decline. Even on the demand side, what will happen, when you raise the prices of imported goods, people start consuming other things. They shift their expenditure to exportable goods. Well, those exportable goods are reduced in supply, so what is left over for exporting is less. So there is no way that you can cut your imports and you will not cut your exports. Conversely, if you think about it, when you liberalize, you're importing more, but you can't import more without exporting more, because ultimately you have to pay for your imports in terms of the foreign exchange. Where is that foreign exchange going to come from? You have to export more. And that is the whole power of liberalization, that you produce more of where you are more cost effective, and where your costs are high, naturally that you allow to be imported. After that, we need to put the financial sector on a stronger footing. I think credit growth is very important. Our credit today as a proportion of GDP is only 50%. Has to grow. And for that we need banks to become bigger, more profitable and creditworthy, so that they can expand credit. And that really requires also the privatization of banks. I think our education system needs to be revamped. Very, very important, obviously, as you know. And now higher education, today, we are still operating under a 1956 law, the University Grants Commission Act. So I think it's time that we bring in a new legislation. Likewise, in school reforms, many schools which have teacher shortages, but then many schools which have excess availability of teachers, they are underemployed, underused. So they should be moved, so it has to be reallocation. So these are some of the reforms which we do need to undertake as we go, as we modernize the country.
Sir, do you think that the current model is good enough to deal with the challenge of poverty and with unemployment?
So this is another very good question, actually, because very close to my heart too, because as growth happens, certainly we can solve the problem of poverty through redistribution. Because more resources become available for the government, and it can kind of, tax people who have more wealth and redistribute it to the poor, and so we can help combat poverty. But the really serious, sustainable, rewarding way of reducing poverty is to create jobs that pay higher wages, higher productivity jobs. So, if you look at unemployment figures, they are 4% or so, little more than 4 sometimes. What is our problem is that people are employed in very low productivity jobs and therefore very low value added jobs. And what we must do is to change the structure of the economy in such a way that there are more jobs which pay well, which have higher value added, and which are more productive.
So coming to the current economic situation, how challenging is it for India, given that inflation is a global problem and central banks are increasing interest rates and also forcing countries like India to increase interest rates, and there's a flight of capital happening. So how do you see that impacting the Indian economy?
In the short term, there is that challenge. I think, around the precisely various macro variables that you mentioned, inflation, capital flight, exchange rate. So there is a bit of a challenge here. Now let's sort of unpack that a little bit. Our inflation target is 4%, but we allow a band around it of plus minus 2%. Currently, inflation we have is about 7%. But it's not outlandishly so. There's no question we need to bring it into the 6% or below range. There is perhaps still some room. RBI has that. It can make use of it. But I won't be overly concerned, especially when I compare it with the rest of the world. Clearly, the source of inflation has been largely external. Oil prices went up, particularly after Ukraine-Russia war. Our inflation is also impacted by that. And also the wheat prices, generally cereal prices had gone up because a lot of the exports that came out of Russia and Ukraine just are no longer coming out. As far as inflation is concerned, I think we can be reasonably optimistic because within this also we have a very large component, vegetables and fruits. So once the new crop of fruits and vegetables comes in, I'm sure we'll see those prices softening up. Oil prices have softened a little bit. Even cereal prices are showing some signs of softening. So I think we'll overcome that. Now, the fact that the U.S. interest rates are rising, and they will still very likely continue to rise, which means that investment into the U.S. bond market becomes much more attractive. And so anybody who has investments in India currently, whether in the stock market or in our bonds, that market, they will partially unload those investments, convert them into dollars, and take those dollars for investment into the U.S. economy, largely in the U.S. debt instruments. And that, of course, means that they would liquidate their equities, they liquidate their bonds, they get the rupees. These rupees they want to convert into dollars. So they are selling rupees, wanting to buy dollars. That means that puts a downward pressure on the value of rupee. And it makes dollar more expensive. And this is where rupee begins to depreciate. Now, RBI has the option that it could come in and say that, okay, I don't want the rupee to depreciate. What I will do is I'll use my foreign exchange reserves, and at the existing exchange rate, I will sell you whatever dollars you want. So RBI in principle could hold the exchange rate, but it's not a good idea. The RBI should certainly do, because you don't want huge volatility in the exchange rate, but some of it should let depreciate. And it is letting it depreciate. So now it has gone to 80 rupees. Very wise decision in my opinion. Because in any case, rupee has been a bit overvalued. And what that does is, when rupee is overvalued, meaning that for any dollar's worth of exports, our exporter should be getting 80 rupees, but it gets only 75 because the exchange rate is held at 75 rupees. Similarly, when imports come in, a dollar's worth of imports sell for 75 rupees, not for 80, which is what should be the right price. So it makes our goods relative to foreign goods less competitive than what they ought to be. So some depreciation therefore is called for, and the RBI has been correct. And by the way, still our rupee has depreciated a lot less than many other currencies. Even euro, which is a developed country currency and regarded to be a strong currency, has depreciated 11-12% in the last 6 months. So we become less competitive relative to our competitors, and we are already less competitive because rupee was overvalued. So that's a challenge we have to, but it's nothing out of the ordinary, nothing that the RBI cannot handle. And after all, we have collected these foreign exchange reserves precisely for these times.
Thank you so much, sir. The conversation was really interesting and threw a lot of light on a lot of the issues and also suggested the way forward. Thank you so much, sir.
My pleasure to be with you, Siddharth.
You were listening to a discussion on economic reforms gathering momentum under the Azadi ka Amrit Mahotsav series. The participants were Dr Arvind Panagariya, former Vice Chairman Niti Aayog, and Siddharth, economic analyst. This program was produced and presented by the News Services Division of All India Radio.